COVID deaths keep falling as cases soar, causing markets to look through the Omicron wave. The Santa rally comes in stocks, but leaves out crypto markets. Inflows are expected to keep January bullish, but macro clouds are gathering for late in Q1 as deflation looms. All this and more in this week's Macro Insight. And the big thing on everyone's minds is obviously what's going on with the COVID situation, okay? Because that has obviously been hanging over our heads with markets. Markets hadn't really reacted too much, and we're starting to price it out. But, you've still been getting some scary press reports out saying, cases are soaring and stuff like that. So, really, you need to look through the case data. You need to look at the deaths. And so despite having thousands of flights being cancelled over the holiday period, restrictions to economic activity still in several major countries, infection rates soaring globally, investors are optimistic that the Omicron wave will be mild and short-lived. And the key to that, like I said, is in the fact that if we don't just look at cases and we look at deaths, then we're seeing very encouraging data. So this breaks it down. You've got Americas, Europe, Asia, etc., all different color coding. You've obviously had Europe really had an explosion in cases first on the Omicron stuff. Obviously, US is following suit. They're all hitting record case numbers, but the bottom chart shows the deaths. And you can see Europe, and this is weekly, and you can see even Europe, right? The deaths are going down week on week, right? So that's very encouraging and explains a lot about why the market is just shrugging this off and doesn't really seem to care. And then where you see this the most acutely is in the price action in travel and leisure stocks. Obviously, it had a big sell-off into sort of November, December time, started to bounce, and is now putting in, some pretty strong price action coming off. It was up like 3% yesterday. So, that's encouraging. We're seeing very similar price action in the likes of the Jets ETF, airline ETF in the US. So these are the type of things that if Omicron was considered a problem, these are the stocks that would be worst hit. And we'd be seeing that in the price action, and we're certainly seeing a recovery there. S&P chart going back a couple of weeks. And, we had that sell-off, customary expiry sell-off that we typically get these days. And then we had a very strong bounce. So you had the Monday after expiry, which is the middle of December expiry, futures and triple quad witching expiry. You had a sell-off on the back of Manchin basically scrapping the Biden Build Back Better. And that kind of spooked markets. You had a bit of overhang from expiry like you often do. And we kind of came off about 2% and we're down to lows of around 45, 40. We then made a bottom like we often do on the Tuesday. And we get the rally often on the Tuesday after expiry. And then within 4 days, we're straight back up to 4,800. Looking at the spot gamma stuff last week before year-end expiry, the big strike that had the most concentration of gamma on it was that 4,800 strike. So unsurprisingly, 4,800 was kind of where we gravitated to, and we couldn't really penetrate that in any meaningful way. So we got to 4,800 in short order, and then we just kind of oscillated around until we hit the 31st, where that expiry rolled off basically. And that big strike, the open interest there dropped by about 50%. So whilst there still is some long gamma around here, it's a lot less than it was before the year-end expiry. Okay, so that now opens up a call wall slightly higher. That shifted up to 48.50 in terms of spot gamma's models, and they see a vol trigger to the downside of 47.45. And you can see that in the chart on the bottom left, right? So that's where they're seeing the setup right now in terms of the S&P and where the kind of gamma lies and where it runs away, etc. But it was just amazing to see how much impact it had up there at 4,800, where we were super volatile when we were away from that strike, and then when we got there, it just stopped dead practically, right? Which was interesting. We've been looking for the S&P to complete this kind of fourth wave correction, right? So we had that original sell-off, Thanksgiving sell-off. We had a decent bounce off that, and then we had this sharp 3-day move lower, getting pretty close to those lows again. And that's typical when you see a fourth wave correction in Elliott wave speak. You often see that third leg down, which is a C wave. That's quite violent. It's quite fast. right? And that kind of fits the bill, the fact that that happened in 3 days. So that kind of smelled very much like a fourth wave correction that's complete for us to then stage a decent move higher off the back of that, right? And the next impulse higher, because obviously looking back at this trend, that next impulse has kind of started now. Who knows how far that impulse is going to go, but a 5,000 S&P target seems pretty realistic for that impulse wave to get to before it kind of does anything meaningful on the downside, basically, right? So it definitely looks like we have got the conditions for that rally to continue. Certainly from a technical perspective, it's done enough on the correction, and I don't think there's a lot really stopping this thing grinding up towards that area over the next month or so. What do we expect for January? So we've certainly got inflows expected, right? So you've got this chart from Goldman's. They do a lot of seasonality work, and they're saying that, you know, the inflows that you typically get in Jan are enormous, right? So percentage of total inflows into equity mutual funds and ETFs, you go back to 96, you look at that seasonality, it's all concentrated there in Jan pretty much. You also got a big month in November, but you know, that is a chunk of inflows that they are anticipating based on seasonality. Now you could argue some of this rally that we've seen in the last 2 weeks has already priced some of that in as people kind of front run those January inflows. Okay. But clearly the weakness we saw in December was a bit of de-risking. There may well be, as people get back into their seats this week, there may be appetite to add risk and put on more positions as January goes on. I think I can sympathize with that idea that we should get inflows in January, and that should be relatively supported for risk. The thing that you would need to be maybe a bit wary of where these sentiment indicators are, because sentiment is winging around like crazy. So when we were at the lows post expiry, sentiment was very, very beaten up and stretched to the downside, but it doesn't take long for it to flip back the other way. So these fear and greed indices, that CNN put these out, and there are various metrics they look at to calculate these. I think they've got about 6 or 7 that feed into this, but this is now dialed up to 68 on the greed side. I think that got as low as like on the 20-30 handle on the fear side. So that is definitely, a month ago it was at 20. It says it was in extreme fear, basically, right? So this has flipped the other way. But really the big question will be is how greedy can we get in Jan? Personally, I don't think it's quite ready to sell off just yet, but it's certainly something you need to keep aware of, like that it has flipped very far the other way. Once it starts to get above 70, then you've got to maybe make sure you're getting some hedges in place, basically, right? So that's something to keep an eye on, I would say. VIX got slammed, obviously, right? We had a big bounce. VIX got slammed on the Santa rally. Shouldn't be a major surprise. If we bring up the charts on the VIX, purple line is the VIX, got as high as around 30, got slammed back down to around 17 where it is now. But then what we've got on there as well is the move index, right, which is rates vol, and rates vol is going nowhere. So rates vol basically saying, you know, we expect things to stay, bond volatility to remain high, as economic and inflation data is probably going to continue to wing around quite violently. So that's the bond market kind of reflecting that in its volatility index, whereas the VIX has just got killed. I would say looking at that, you know, if you're long risk, maybe you want to look at some put spreads. If you agree with the bond market being more cautious than the equity market, and if you are long risk because you think there's legs still for this January rally to happen, looking at the right side of the chart, that's the skew index. So that shows you where the pricing of skew is on the S&P, and that's kind of bounced back up towards local kind of high area. So when skew's high and vol's low, which is what we're seeing, VIX low, skew high. If you see that, then put spreads are kind of the way to go if you're looking for protection. So putting on some put spreads either now or over coming weeks as we get that final leg higher towards 4,900, 5,000 on the S&P, that probably needs to be on your shopping list if you want hedges, right? Saw some interesting charts talking about the small business surveys. This NFIB Small Business Confidence Index is at recessionary levels, right? So you look at the top left chart, this index has kind of rolled over from the peak that it made recently, and it's gone below 100, which is kind of now recessionary levels in terms of confidence, okay? Small businesses are citing concerns over inflation and spending that was pulled forward due to stimulus checks. And that's basically supported disposable personal income, but that's now gone, right? So if you look at the chart on the top right, you've got retail sales in blue, you've got personal disposable income in black. That had a big spike in line with retail sales, but now that's rolled back over to trend, right? Whereas retail sales are still quite far above trend. So the idea being that you would expect retail sales to come back and mean revert towards trend which is not going to be good for small businesses. So that's something that we're looking at. Doesn't bode that well for economic activity in the kind of 3 to 6 month time frame probably. And then you look at the underperformance of small caps. Bottom left, you had the Russell up about 14% versus the S&P up 28%, right? So double, decent underperformance of small caps last year. And the idea being that if you then look at how this confidence index correlates with the returns, year-on-year changes in the mid caps or the small cap stocks, then you see that you've had this rollover in confidence, and therefore it would be fair to assume that small cap stocks are going to have a relatively tough time. And so you're probably going to continue to see underperformance. So if we are lucky enough to get a squeeze in small caps in the next month on the back of this kind of end of Omicron and even end of COVID type play and a bit of animal spirits coming back to start the year, then it could be a good idea to rotate out of small caps on the basis of like these confidence gauges, basically. So there's your chart on oil where we've recovered up to this retracement level about 77. But if you look at the oil futures, it's in backwardation, right? So that generally signals a tight market. So you'd think that it's still bullish in terms of the setup for, people are paying a premium for short-term oil. That signals a tight market. You've got Omicron wave kind of not going to be as bad as we think. That's certainly what's being priced in travel and leisure stocks and stuff. So should all probably be all right for oil in the short term. But, if we do roll over in growth and we do go into deflation, then oil's not going to escape that, right? So something to watch out for. Probably going to be quite a volatile ride. But right now, I picked up some oil on that dip in the high 60s. So I'm running my long for now. Quite happy with that. So not in a rush to exit that. We were saying like in the oil market was only really going to rally once the speculators came back. Well, they seem to have come back, right? So across the space, particularly in the ags. So if you look at soy, beans, corn, etc., they've seen some pretty bullish change in positioning from the specs, but you've also had it in Brent, you've also had it in the metals. So across the board, specs are coming back, and that was in the last week of the year. So in the last week of the year, people decided to throw a bit of money into commodities in terms of the speculative positioning, right? So encouraging that some of those players are chasing this commodity story. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.